every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Tuesday the 14th of May. It's a holiday shortened week here in Hong Kong. We get a day off tomorrow. Before that, let's catch up on this morning's business, finance and economic news from across Asia. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, Philip Jefferson, Vice Chair of the Federal Reserve, said Monday the US Central Bank should keep interest rates in restrictive territory until it has additional evidence that inflation is moving to its 2% target. The Fed's indicated that it intends to keep interest rates higher for a longer period of time in light of higher than expected inflation data recently. Chinese authorities have kicked off plans to sell 1 trillion renminbi, that's about $140 billion of long-dated bonds, as Beijing ramps up spending to stimulate the economy. The central government will begin a flurry of such sales this year by issuing 40 billion yuan of 30-year bonds on Friday, according to a notice by the Ministry of Finance. The government says the sale will support investment in key areas and reinforce economic momentum in the second quarter amid the country's lengthy property crisis. Indians voted on Monday in the fourth phase of a 7-week-long general election. The world's most populous nation began voting on April the 19th in a 7-phase election in which nearly 1 billion people were eligible to vote, with ballots set to be counted on June the 4th. Polling was held yesterday for 96 seats in 10 states and territories, with 177 million people eligible to cast their ballots Monday. Anglo American has rejected a raised takeover offer of $42.7 billion from BHP Group on Monday, saying the world's largest listed miner continues to significantly undervalue the company. The London-listed miner had earlier rebuffed BHP's initial $39 billion all-share proposal made on April the 25th, dismissing it as opportunistic and saying it would dilute the upside for its shareholders relative to BHP's. On today's Money Talk, we're joined by Richard Harris, Executive Officer at Port Shelter Investment Management, Nick Marro, Lead for Global Trade at the Economist Intelligence Unit, and in Washington DC, our US Economics Correspondent, writer and broadcaster Barry Wood. This morning's Asia newsletter is now available with a lot more information on today's top stories. You can find it at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
Trading on Wall Street's Monday was quiet ahead of the release of closely watched inflation data. The S&P 500 oscillated between small gains and losses, with all sectors except real estate and technology in the red. The broad-based index ended the session virtually unchanged at 5,221. The Dow ended its longest winning streak of the year, falling after 8 sessions of gains. The 30-stock index fell by 81 points, or 0.2%, to 39,432. The Nasdaq Composite added 0.33%, closing at 16,388. All three indices have advanced by at least 3.6% this month. The yield on the 2-year Treasury was down 1 basis point at 4.86%, while that on the 10-year note was down 2 basis points at 4.49%. The US dollar index edged 0.1% lower towards 105 on Monday as investors braced for key US inflation data this week. The offshore yuan depreciated 0.1% to around 7.24 renminbi per dollar, responding to key economic data from China and the looming threat of US tariffs. The Japanese yen eased 0.33% to 156.22 yen per dollar, remaining under pressure as investors look ahead to Japan's first quarter GDP reports this week. Gold prices completely paired Friday's upside and gave back more than half of last week's gains. Spot gold settled 1% lower at $2,337 an ounce. Brent crude oil settled 0.7% higher at $83.36 a barrel, and Bitcoin more than erased Friday's losses of 2.6%. It rose 3.3% to back above $63,000. Chinese equities led losses in Asia on Monday after the country's central bank published data indicating weaker than expected credit demand. The Shanghai Composite fell 0.2% to 3,148. In Hong Kong, the Hang Seng rebounded from opening losses to end the day 151 points, or 0.8% higher, at a 9-month peak of 19,115. And the Hang Seng has risen 7.6% so far this month, following a 7.4% jump in April. The tech index rallied 1.4% Monday, and that takes its gains for the month so far to 8.6%. Futures markets pointing to further gains for the Hang Seng at the open. Looks like it's going to rise about 130 points to 19,245. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Tuesday morning guests. We have with us Dr. Richard Harris, Chief Executive Officer at Port Shelter Investment Management. Morning, Richard.
Good morning to you.
And also with us is Nick Marro, who's lead for global trade at the Economist Intelligence Unit. Morning, Nick.
Good morning.
And over in Washington, D.C., we have our US economics correspondent, writer and broadcaster, Barry Wood. Morning, Barry.
Good morning, Peter.
What's the Washington weather like this morning?
We have had a glorious Monday morning, and it continued all through the day. Temperature about 24 degrees, not a cloud in the sky. As I mentioned last week, most of the blossoms are gone, but boy, it was a good day to be outside.
All right, well, let's stick with Washington then, because we've got several media reports reporting that President Biden's administration is poised to unveil sweeping decision on China tariffs today. The new tariffs apparently are going to focus on industries including electric vehicles, batteries and solar cells, with existing levies largely being maintained. Officials particularly focused on electric vehicles, and it's expected the Biden administration to raise the tariff rate to roughly 100% from 25%. So, Barry, any news yet on what's happening on these tariffs?
No, but I think it's going to come from Catherine Tai, the trade representative, and I think Tuesday is the solid date, so we've still got 24 hours before that announcement, or could be that long. Look, it's significant. It's political, because the last thing that President Joe Biden needs is to have some new and highly regarded Chinese-made electric vehicles underselling every other car in this market. So if you go up 400%, from 25% current to 100% tariff, then you've made the price in the eyes of the Americans prohibitive for the Chinese to sell. But we shall see. Let's not forget that in China, as well as Europe, and particularly the United States, EV prices have fallen very dramatically in the course of 2024 as the market has cooled. But yes, I think that this is a 4-year-long study of under the 301 legislation, which means whether the Chinese are playing fair. They'll, of course, say they're playing absolutely fair, and it's the Americans that are abusing World Trade Organization rules. We shall see.
Do you think, though, this is the right way forward? Because it doesn't really make American EV manufacturers more competitive, does it? You just put these tariffs on, you lock out Chinese vehicles from the markets, which of course is going to hurt the consumer. But there's nothing in this that seems to say, well, OK, how are we going to use this period, for however long they last, to make sure that American manufacturers do become more competitive?
Well, that's true, Peter. But at the same time, you've had this CHIPS Act, you've had the IRA legislation that has thrown all this money, industrial policy, to boost American manufacturing. And you've got Tesla, which is the low-cost producer in the United States. They have, in fact, just laid off 10% of their labor force, even more. So they're going to say, the Americans clearly are saying, it's all been set up by Janet Yellen, by Catherine Tai, others in the administration, that the Chinese are, in fact, using this overcapacity. They cannot sell all these vehicles at home. They put them on ships, send them to Europe and America, and sell them at a lower price.
Well, let's bring in Richard and Nick on this. Richard, first of all, what's your reaction to this?
Well, I think it's also a case of history repeats itself. In fact, the Americans did the same to the Japanese back in the 80s. And what we saw then was the Japanese started to onshore. They put factories in the US. In fact, it's a little bit, as you were saying a moment ago, does it actually help US manufacturers? Because Toyota became the largest car manufacturer in the world. But I think it's actually a natural progression. When you have an economy that is as big as China's and can produce, these goods at very low unit costs, they have a natural advantage. And of course, markets don't want to be absolutely flooded. And this was exactly the same as the Japanese in the 80s. So in a sense, it's a case of history repeating itself. I'm not surprised, and I think the Europeans will do it next.
Well, Nick, you're our trade experts here, so what's your reaction to this proposal?
Yeah, we've had some really good discussion about this anyway, so probably not too much to add, but it does seem like these proposals are inherently political. If you look at the nature of trade flows between China and the U.S., Chinese EVs occupy a very, very small percentage of the U.S. market. And that's mostly because Chinese automakers have largely either been shut out of or have avoided the U.S. market following the Trump tariffs that we saw in 2018, 2019. And so talking to some of the contacts that we have in Beijing, Chinese automakers themselves aren't super worried by this. They've been expecting this for a while. The U.S. isn't a priority market, but it's the political signals that are attached to all of this. On the Chinese side, it's the fact that they are already, facing down these headwinds with the Europeans. That's really the tariff fight. That's the one to watch, following Xi Jinping's, charm tour to Europe to try and kind of discourage the imposition of EV tariffs, later this year. We don't think that's going to be successful. We are anticipating the EU to impose tariffs on EVs in the coming weeks, months, quarters. And why that matters is, if we see the U.S. moving on the same topic, it does give this sense of encouragement to other markets to adopt similar measures. This idea that, there's countries that are falling in line, and then from the Chinese perspective, countries that are kind of coordinating to box China in. And then on the flip side, when you look at the U.S., we saw the announcements leading up to all of this, just like Barry said, a potential 100% tariff on some of these goods, including tariffs on battery manufacturing and types of solar cells. And after Biden announced this, or after this was signaled by the Biden administration, we then saw Donald Trump say that Biden's not going far enough, and that if Trump were in power, he would impose 200% tariffs. Which, when you look at this, again, the economics don't really justify what's happening here, but it's coming down into the political clown show. And so that's, again, really where we're seeing a lot of the significance, what this means for the future of trade policy and the two candidates in the run-up to November as they try and kind of brandish their hawkish credentials and seem tough on China.
Do you know, for the whole of my working life, which started at the beginning of the 1980s, globalization has been seen largely as a good thing, but in particular, the trend has always been to remove trade restrictions, to reduce tariffs, to get them down to zero if possible, to try and remove impediments to trade. And trade between countries has always been seen as a good thing. And America as well has often been at the forefront of that, and has been encouraging more and more countries to try and join in that process, to join the World Trade Organization, and to basically have frictionless trade. It seems to me, really for the first time in my working life, that advancement of trade, reduction of tariffs has come to an end. Am I being a bit too gloomy there, or is that really how you see it as well?
Well, I'll jump in. I think you are too gloomy. I think globalization is here to stay. It benefits so many millions of people worldwide. But you can't have a wage disparity of several 100% between, say, China and high-cost Europe and high-cost America and expect there to be free trade there, because it just doesn't work. Now, Nick was right to mention, or I think it was Richard mentioned, the Japanese example in the 1980s. That's true. The Americans at that point had their own companies almost at death's door, and quality was perceived by the American consumer to be low standard, and the Japanese quality was regarded as high. We haven't really seen Chinese vehicles in the States, but we do know what happened to the solar panel industry. Solar panel industry that had all these hypes and all these great things were going to happen 5-10 years ago, that's essentially dead now because of Chinese imports. So it gets complicated. But no, I don't think globalization is dead at all.
There's also, I think, Peter, a hunt for revenue. Governments are finding that it's EVs appear on the roads. You've got lower fuel tax because, the Greens have often put lower fuel taxes on these vehicles. But also there's no fuel. There's no road tax as well. So I think governments are finding that, as EVs come in, there's a reduction in revenue. So how are they going to get revenue? I think tariffs is one way, and it has the added advantage of maybe adjusting demand a little bit. I think the system will adjust. We have 100% tariff on cars in Hong Kong. Hasn't stopped people buying cars in Hong Kong.
But hasn't the war been lost in electric vehicles? Countries like China are always going to have a cost advantage, aren't they? Because wages are so low compared to Europe, Canada, America. So, and they made the investment a few years ago now, whether it was with or without subsidies, the investment has been made. They've got a low cost base. When it comes to EVs, Nick, do you think the war has already been lost to China?
That's a loaded question. But I do think China does have dominance in this industry, which is going to be hard to replicate. But it's interesting because when you look into the, economic structural factors here, there's a lot of reason why people not in China are very upset. I mean, if you look at the development of the EV industry over the past 10 years or so, when I was in Beijing, for example, in the early 2010s, the Chinese policymakers were aggressively subsidizing this industry. In 2014, 2015, the amount of support that you were seeing from the Chinese state to EV makers was incredible. But a lot of that support wasn't being offered to foreign invested firms. It was very much kind of a protectionist element aimed at cultivating national champions around this. And so on one side, there's this idea that, yes, this industry is developing, but in somewhat of an inherently protectionist way, whereby not only are imports disadvantaged, but foreign companies who are operating within the Chinese market and sourcing from the Chinese market, producing in the Chinese market, they themselves are also not able to benefit from these types of subsidy programs. And the second thing is kind of this wider discussion around the structure of the Chinese economy, the fact that Chinese demand has been very weak over the past couple of years. And if we look at the growth projections for China this year, it is very much anchored in this export-oriented manufacturing story. The fact that as domestic demand falls, as producer prices remain weak, price wars between EVs kind of intensify, Chinese companies are looking at overseas markets to alleviate some of that pressure. And so it's a complete kind of mix of industrial policy, this idea that, the rest of the world has to make up for the lack of demand that is in China. And it's, I think, those structural economic imbalances which are making people really, really concerned, because it's not just this idea that, the second largest market in the world is producing EVs at a very cost competitive kind of position. It's also the fact that the second largest economy in the world isn't buying these EVs or EVs from other countries. And these imbalances are splitting out.
Isn't that how trade works, though? When you're not selling enough of what you produce domestically, you export it. Isn't that what countries all over the world do? And isn't that how the economy works, basically?
It is, but I think when you also look at the Chinese economy, I mean, so much of what we're seeing right now has been distorted by market policies that have suppressed consumption. They have incentivized kind of transfers of wealth from households to businesses. The fact that the entire economic model in China is still very much around this idea of kind of subsidizing production at the expense of cultivating demand. And I think, 20 years ago, when the Chinese economy was still growing, people were still ringing alarm bells around this, but there was this idea that as China kind of fits into the global trading system, as domestic demand develops, these imbalances are going to straighten themselves out. And in many ways, they never did. And particularly after the pandemic, they've intensified. And so it's that whole idea. This is very much kind of a policy-driven outcome by Beijing in ways that are suboptimal for the rest of the global trading landscape.
I think in some ways, Beijing's been a victim of its own success. It has been very successful. And I was in China last week and at the Shenzhen railway station. And the extraordinary thing was how quiet it was, because all of the cars, all the taxis are new EVs. Motorcycles are now electric or the scooters. And not only was it quiet, but it was also quite clean. It was almost a blue sky day. So actually... Wow. we're seeing a real dramatic change, I think, in China. This policy is changing how China is domestically. And I think that people forget or don't really realize overseas quite how far China has developed in the last 3 or 4 years over COVID.
And these Chinese EV companies, even if they can't export to the US or Europe, they anyway export most of their cars to developing economies. There's presumably still a big market there for them, so they're not going to suffer. They're just going to switch their exports to other markets because there is still global demand for electric vehicles.
Richard alluded to this. I thought it was very, very accurate. This idea that, we're adjusting to this new reality around globalization. To that question, Peter, you asked around, is globalization dead? Maybe politically it's coming under pressure, but when you look at the economics of trade, supply chains are just realigning. Demand is just kind of migrating to other parts of the world. So if you look at the EV supply chain, for example, or autos in general, just like you said, Peter, we're seeing a bunch of these products being shipped into, say, the Southeast Asia, to Latin America, and then they are finding their way into the U.S. via those third markets. I think that's the bigger thing to watch, this idea that trade officials, both in the Biden administration and a prospective Trump administration, are talking about Chinese brands getting into the U.S. market via so-called backdoors, whether that's via Mexico or Thailand or wherever. This idea that third markets are facilitating this, which I think is a nice indication that globalization persists, and in some ways it thrives because it just shows that supply chains are elongating, but they're still as relevant as ever. But from a political angle, does that then raise the question of Mexico or Thailand coming into the crosshairs of U.S. trade policy?
Yeah, I would simply add to what Nick just said, that Chinese manufacturers are involved in a very competitive market at home. So this is not communism. This is not 5 decades ago. This is extraordinary because the price drops in China and the amount of companies that are involved in the EV competition. That's what got Elon Musk's attention and caused him to rush to China a couple of weeks ago. And let's not forget that the Tesla plant in Shanghai is the biggest in the Tesla network, and it creates about 1/2 of all of the Tesla production. They have cut prices. Tesla's cut prices. But one thing sure, Nick, they don't benefit from those subsidies that were so pronounced when you were there in Beijing.
So what's happening with Tesla? Because they're cutting jobs, aren't they, around the world? Their market share in China in April dropped 2.6 percentage points to 4%, and their EV sales in April, they declined 21% year on year, even though overall in the country EV sales were up 28%. Is this a problem that is specific to Tesla, or is Tesla just the victim of all of this protectionism that you've just been talking about in China?
Well, I think Tesla is the standard EV manufacturer. It's been leading the way all the way through. It had a good inroad into China, but now it's facing massive competition. So I think it's always a target. I mean, a lot of people, including myself, have been predicting Tesla's decline for years, and we've been incredibly wrong. It's going to be interesting to see how they develop, though, because obviously, Musk has been, as you said in your introduction, has been flip-flopping a lot about what he wants to do. Are we going to do chargers? Yes, we are. No, we're not. Now, apparently, we're back again. So I think Tesla's danger now is policy flip-flops, especially if they feel that they're losing market share. And whether their cars can actually keep pace with the development, not only in China, but also EV manufacturers all around the world.
So, Barry, where does this all end now? If these tariffs go ahead, 100% tariffs, there doesn't seem to be any talk of any sort of sunset clause on these. So, in other words, they could go on indefinitely. What's got to happen? What does the US government want to see to make it feel more comfortable about getting back to a more normal trading environment, reducing tariffs so that there aren't all these restrictions? What do they need to see?
I don't have an easy answer. I think that it's not impossible to think that there may be a situation evolving where the Chinese do something like the Japanese did in the 1980s. They either build plants in the States, which seems preposterous on one level, but on another level, there's a lot of Chinese manufacturing in the States. So that might be a way that the Chinese would argue to defuse the problem. But nonetheless, those cars would probably be costing a lot more than the imported from China cars. That's one possibility. I think the Biden administration simply does not want to be outmaneuvered by Donald Trump. So I don't know where it's going to end. But if you go to any big box retailer, you'll see that globalization is very much alive. The goods come from everywhere, particularly in Asia. So, it's not under threat. The States is not going to pull out of the World Trade Organization. It's not going to go back on saying what used to be called most favored nation trade is an anachronism. No, I think that it's alive. The American consumer is a huge beneficiary of globalization.
Does the Biden administration, does it welcome Chinese manufacturers opening plants in America? Because the EU certainly does, doesn't it? The EU says, although it also is very concerned about the low cost and the protectionism, but nevertheless they encourage vehicle manufacturers to open up in the EU. So you've got BYD opening a big plant in Hungary, for example. Would the Biden administration welcome BYD opening a plant in America?
I think maybe they would. Let's not forget that in South Carolina, where I was a couple of months ago, Volvo, which is owned entirely by Geely, they have a huge facility there. Now, it's completely run by Volvo Europe, Sweden. But that is, I think you have to say, a Chinese investment. And so, look, EVs are the arena to watch because this is where the action is. Yes, everyone can say, well, now Toyota's won because they were the hybrid champion, and that's where the market has moved. But I think the market's going to move back towards EVs very quickly, particularly if the prices come down.
This, Nick, seems to be a problem, doesn't it? Not just for the US, but for a lot of developed economies in a lot of different sectors. We had the European companies saying they find it harder to make money now in China because of overcapacity pressures, slowing growth. That's according to a survey from the EU Chamber of Commerce in China. And they warned that European businesses are at growing risk of structural decline in China because they face head-on competition from Chinese rivals, which are increasingly moving up the value chain. We're going to see more of this, aren't we?
I think so. I think when we talk to companies, for example, I guess what I'll say is, 10 plus years or so, in the early 2010s when I was in Beijing, you talk to companies, China was their number one investment priority. It was number one in their investment strategies. By the time I left mainland and I came to Hong Kong in 2017, China had slipped from the number one market to within the top three. So still, pretty important, but not the most important. Nowadays, when you talk to a lot of companies, China is within the top 5, the top 7. So still an incredibly important market to be in, but it's not, the one that's capturing most attention. Maybe you're thinking about new investment. You're looking into Southeast Asia or even India or Latin America for whatever supply chain reasons or consumer tapping up opportunities you have. So what all that means is I think companies now are very much reassessing their exposure to the Chinese market. We are seeing, I guess, this to, borrow the phrase of the industry associations, moderating optimism in the Chinese market. And that's tied to a bunch of different reasons: the slowing economy, the growing competitiveness of Chinese firms, as well as some of the soft structural barriers that we're seeing kind of persist in the business environment. The fact that, Beijing continues to say that it's encouraging reform of the FDI regulatory landscape, it's trying to encourage market access, but in practice, getting the right licenses or navigating the various administrative regimes to actually bring your product to market or to play on an equal footing in China, those are still very, very difficult and in some ways have intensified for some sectors, particularly in, say, ICT or other potentially sensitive technology and other types of sensitive sectors. What that means, I guess, for kind of the wider picture is the fact that businesses have historically been kind of a positive lobbying force for home governments, whether that's DC or Brussels or wherever. I think right now we are seeing these companies play a little bit less of an active role in encouraging, say, the stabilization or the positive development of China bilateral ties with whatever market you're talking about. I don't think anyone's calling for decoupling from the corporate sector or talking about how the West needs to impose punitive measures on China. But we are seeing this moderating optimism translate into less enthusiasm for kind of the China growth story, the China business story. And even when you look at kind of the things that China is offering, as part of, say, Xi Jinping's tour to Europe last week, for example, the market access things he offered to France regarding, say, pork exports or deals around aviation. These are repackaged deals. They're deals that don't really fundamentally change kind of the demand or the trade landscape between Europe and China. And so I think China itself is also struggling to kind of reinvigorate this conversation and offer new concessions, given the fact that we're just in a very different state than we are a couple of years ago, particularly as Chinese companies are much more interested in gaining the market, and the Chinese government is much more interested in facilitating that to happen.
I think actually that also fits in with my particular theme of the moment, which is that China is no longer a developing market. It's a developed market. You only have to walk down central Shanghai, Beijing. Shenzhen is just incredible in terms of its level of development. So I think we need to look at it as a developing market, which means it's not a market now that you just go into and scatter around. If you're a company coming from overseas, you've got to have the rifle shot. You've got to go in. You've got to know what you're doing. You've got to know the market and what you want to do. It's going to be a lot more cerebral than it has been before. China needs to be regarded as a developing market because it is, as a developed market because it is.
So how does that change things for Western companies?
Well, I think they have to be much more focused. And look, if they're going to go into China, they need to think of how would they go into Europe? What are the local markets? What are the local markets within China? Are there particular sectors they can go into? They have to be much more sophisticated and much more granulated. China isn't just one big amorphous mass. It's as diverse as Europe in many ways. And I think companies are going to have to try and figure that out and really concentrate a little bit more on the detail.
Okay. Let me switch attention a little bit. I just want to get some comments on the economic data that we had over the weekend. The thing that stood out was the loan data. China's new bank loans declined sharply in March. The latest figure was the smallest amount of loans since July 2023, and total social financing, which is a broad measure of credit and liquidity in the economy, actually logged a negative reading of 200 billion renminbi. That's quite a rare negative reading, and it's the first one since January 2002. Now, obviously, it's only 1 month's data. But how concerned should we be about this and what it says about demand in the Chinese economy?
Yeah, I think it is. It is concerning, particularly when, major indicators like this turn negative. I think there is still a bit of optimism that things are going to improve. Commentators say that April is seasonally kind of a low month for credit demand. We just got news within the last 48 hours that China is going to be issuing very long planned special treasury long-term bonds later this week. And so there's kind of this assumption that this type of demand is going to rebound. But I think you're right, Peter, in the sense that when you look at this in the wider context of where the domestic demand landscape is, it is a bit concerning. We saw the consumer price inflation prints come out over the weekend, which illustrated that there's some, pockets of demand that are coming back. We see this particularly in services rather than goods. But when you look at the producer price index, it's still very much a negative territory. We're still having anecdotal reports of kind of price wars in the Chinese market. We just talked about that in relation to the EV story. And so what that means is the demand landscape is still really, really fragile. And I think a lot of people are interpreting this monthly data as somewhat of a one-off right now rather than the beginning of a trend, but it should still be capturing our attention. The fast growth that we saw in China in terms of real GDP expansion over January and March, I think came above a lot of people's expectations. But at least we at the EIU, for example, we're still holding our breath a little bit in terms of what this means for kind of sustained momentum throughout the remainder of this year. We've been seeing some high frequency indicators suggesting that this momentum seems to be petering out in some areas. And I think the credit data that we just got is somewhat of an illustration of that. And so to sum up, I think this is not going to necessarily begin, a new trend in terms of very weak kind of credit demand, but that's the big risk. And that's what people should be bracing themselves for, even if we start to see this special long-term treasury bond issuance begin to pick up starting from this week.
Do you think this 1 trillion renminbi of special bonds, these long-dated bonds, which China has only done, I think, 3 times before, hasn't it? Is that going to help? How is that going to get domestic consumption going by investing more in certain manufacturing sectors, certain favoured sectors? How is that going to help domestic consumption and get households to start spending some of their excess savings?
No, I think it's basically adding more fuel to the fire, because we've had quite a lot of stimulus in the markets over the last few months in China. I think we're probably looking at maybe $1 trillion already, and then you've got this coming through. My initial thought was that we would actually see a big bazooka, but I think the authorities prefer to try and drip money into the market bit by bit. And once again, it reinforces my feeling that China is now a developed market, where they need from time to time to stimulate the economy in this kind of way.
Yeah, no, I agree with that. And I think that, one of the things, Peter, you just mentioned this, but, how does stimulus into kind of the corporate manufacturing sector, lead to an increase in demand? I think the short answer is it probably doesn't, which is, I think, exactly to the point that we talked about a couple of kind of iterations in the conversation ago around the fact that the China growth story is still very much one around production right now rather than a revival in consumption. Policymakers in Beijing still seem to be scratching their heads in terms of how to actually revive household demand. They're still very unwilling to engage in, say, direct household transfers, so stimulus checks like we saw in the West or even here in Hong Kong. But that, honestly, would probably be the bigger, more consequential policy that would revive consumer demand, consumer expenditure. The types of bond issuance that we're seeing right now, that's likely going to be used for, long-term infrastructure investments, which is coming back to the traditional Chinese toolkit of juicing the economy. And indeed, if we look at the investment story this year, we're expecting a lot of this investment story to have to come from the public sector rather than the private sector. So in some ways, it's encouraging in terms of signaling that policymakers are responding to these conditions. There's going to be a natural uptick in demand. But when you pop up the hood and see where this demand is coming from, it's still a bit disappointing in the fact that it's coming from parts of the economy where maybe there's been too much of a focus and not the other parts of the economy that really need attention.
Okay.
Yeah, there's a lot of fixed capital investment in the economy already. And in some ways, it is a bit disappointing that that's focusing. I like the idea with Nick of handing out checks to ordinary people, because that's the only way you get trickle down. Otherwise, the wealth stays right at the higher levels.
Barry, can I ask you about the US data? The probably the standout data that we've had in the last couple of days, the University of Michigan Consumer Sentiment Survey. The main index fell to a 6-month low, but what stood out was a big uptick in inflation expectations. The one-year inflation outlook jumped to 3.5%, which is up 0.3 percentage points from a month ago, and that's the highest level now since last November. And Barry, are consumers still worried about things like inflation, about unemployment, about maybe interest rates moving higher? Is this still very much on their minds?
Yes, it is on their minds, and I think that's because they're stretched. They're having a harder time. Prices clearly are higher. That's why there's so much discussion in the media here about inflation, even though the trend line is down. I think people are worried about price rises. They're worried about the possibility of further interest rate rises, although that seems unlikely. And they don't see that their jobs are necessarily secure. So I think this University of Michigan data is significant. It might even be a canary in the coal mine. But on balance, the United States economy is doing just fine.
But President Biden doesn't seem to be getting the credit for that, does he? It's he's struggling really to gain traction in the polls. Is that partly because of consumers' concerns over things like unemployment and interest rates? They still have that in the back of their minds. Why they're not crediting him for the improvement in the economy, which there has been a clear improvement, hasn't there?
Right. There has been. No, I think that's exactly right. For the reasons that the University of Michigan has pointed out in this survey. People worry about inflation. They worry about interest rates. They worry about their jobs. And the president doesn't get these benefits. He should, but he doesn't.
Richard, final comment from you on the US?
Well, I think at the moment the markets are kind of, in the sense of eat, drink, and be merry, for tomorrow we die. It's a momentum trend, and they've been going up despite a lot of other factors. And momentum often holds for longer than we think. But I think the US election is going to be a big event, and maybe that's what will bring into focus some of the risks out there, the debt risks, the geopolitical risks, some of the economic risks too. Basically, we just got to hope the consumer holds up throughout all of it.
Yeah, you're right.
Nick, it puts the Fed in a bit of a bind, doesn't it, when it's seeing sort of sentiment weaken, but at the same time, inflation expectations moving up.
Yeah, that's right. And I think the story for the Fed for, since 2022, 2023, has been this idea of, can you thread the needle in terms of getting monetary policy in a place that doesn't derail growth while still bringing these expectations down. To Barry's point, in a sense, the Fed's done really well. The U.S. economy has still been really, really resilient. But I think there's more to disappoint investors than there is to enthuse them. For a long time, at least we weren't expecting interest rate cuts to begin until June. Now it's not looking until September. The market was expecting March. I think there's a lot to go in terms of where kind of market expectations and anticipation is going for all of this. And I think for us in Asia, the big story is, what does this mean for currencies? What does this mean for growth out here? What does this mean for central bank tightening regimes for Indonesia, for the Philippines, for Thailand, whatever? And so we're not out of the woods yet. And this is going to be kind of one of the main global stories to watch through the remainder of this year.
Barry, final thoughts from you. We've got important inflation data coming out, haven't we, this week? We've got producer price inflation later today, the consumer price index data tomorrow. This presumably is the most important data that the Fed is focusing on. All this other data really pales into insignificance compared to that. Yes.
Yeah, if there's a big uptick in inflation, that would be a problem. But I think the markets, whether they're right or not, are thinking are modest improvement. So if it's in line with market expectations, the band plays on.
And Fed officials, they all seem to be singing from the same songbook. Basically, we need to see more data to convince us that inflation is moving back to target before we cut rates.
Yeah, I think that's exactly right, Peter.
Okay, well, thank you very much. You heard there our US economics correspondent over in Washington, D.C., Barry Wood. Nick Marro, who's lead for global trade at the Economist Intelligence Unit, and Richard Harris, Chief Executive Officer at Port Shelter Investment Management.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Just a reminder once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news from across Asia to go with the show. There's no Money Talk tomorrow, as it's a holiday for the Buddha's birthday. I'll be back on Thursday, when my guest will be Andrew Ferris, the CEO of Economist Advisory, and with a view from Taiwan is Ross Feingold, Director of Research at Cyrus Consulting in Taipei. Enjoy the public holiday.
Money Talk.